We're back. Time for Ask Annex. In the studio, Matt Morzy, Director of Research and a CFP at Annex. Hey,
Danny.
Fred Coleman, CFP and a Wealth Manager. Welcome to you.
Thank you, Danny.
Right before we got on air, I asked you, what is the pass rate for CFP? It's no picnic.
No, it's not at all. I think it's around 2/3, 60% or so, maybe a little bit higher, but it certainly fluctuates each one of those testing cycles.
Yeah, not easy at all. You do have to put the time in, go through different elements, and not a high pass rate.
Well, I appreciate it.
Yeah.
Appreciate that you guys are here and you have CFPs. Our first question on Ask Annex. I'd like to teach my grandchildren about investing. When I was younger, my grandfather bought single shares of stock for my brother and I. I'm not sure it taught us much. Is there something more modern? Should we explore specialized ETFs that cover interests they might have? That's not a bad idea.
When I think about teaching kids about stocks and ETFs and investing, I always try to make it relatable. So for me, I want to make it easy to understand. So I like to relate it to the things that they like to do. So I would say single stocks, because if you think about it, kids, they play with toys. There's a toy maker that has a stock. They watch streaming services. You go out to eat. All those things you can relate back to a single stock. So if you're able to, relate it to things that they do and make it easy to understand, I think that's the best route to go. For me, single stocks have always been much easier to understand. Also thinking about that they pay dividends, thinking about taking that dividend in cash, that'll also give the kid a sense of like, hey, if I invest in this company, they make profits, they pay out some of those things, and hey, I got a check. Even though it's a little, old-fashioned, after a while, you start reinvesting that as they get more advanced. But just to start out, those are two things I like to do.
Yeah, I think from an ETF perspective, depending on what they're interested in, it might be a great way to learn about what other companies are out there that they might not know already. So if you think from an AI standpoint, which, is becoming more and more big news, looking at different AI ETFs out there are going to probably show you a lot of companies that either one you've never heard of before and would be a good area to kind of dig into with the grandchild, or maybe some companies that you wouldn't have thought were AI companies at all that, they can go and find out how they're using it and kind of where that's kind of coming from. But it's a great way for maybe to gain some additional exposure. But, if you're thinking about, putting the stock market in front of them and trying to teach them about them, but it didn't quite work for you, I would think of the ways that, hey, maybe I would have done this a little bit different. What didn't I get out of it, and what might have interested me a little bit more as a way to frame some of that out.
But what if you bought a single stock and it just augers and just crashes, right? Wouldn't that turn a kid off?
Potentially. No one likes to lose money, right? But that's a part of investing. You don't want to just show them the upside. You want to show them the risk and the downside, and then potentially attempting to explain why the stock did go down. And if you buy different stocks, hopefully all of them don't go down, so they can see like, hey, I bought one of these companies I bought was a good performer. One of them was a not so great performer. And they get to understand the risk a little bit better.
Yeah, I think, the stock market's not free money, right? It doesn't go up every single year. Not every single stock goes up every single year. In fact, many of the years where the market's up, a lot of the individual stocks that make up a certain industry are going to be down on the year, and some of them are down quite a bit. When you think through that, the earlier that you learn about the risk side of the markets helps you become a much better investor as you get older and more in tune to it, because you're aware of what the downside is, how to potentially prevent that from happening within your portfolio in terms of structuring in the right way to minimize your downside risk. But knowing that's not free money, that you're not guaranteed to go up every single day, is a great way to learn too.
Next question on Ask Annex, and you'll need to explain this, but why fractional shares?
Essentially, if you think you got a whole share of something, you could break it apart into little pieces, which is what the mutual fund industry essentially does already. Traditionally with a mutual fund, you're going to buy and sell a certain dollar amount of it. So I want to buy $10,000 of this certain mutual fund. And what they do then is they take the price of the fund, take your 10,000 divided by it, and then you get so many shares. Maybe it's 105 shares, 0.2345. So you get the full amount that you put into it, just broken up. So the fractional shares for stocks, it's the exact same thing. Now, it's not available all over the place. There's a lot of operational burden from a standpoint of the custodian or the broker that's holding on to that. So they don't necessarily make this available to everybody in all situations, but it is a great way to gain exposure to some of those without necessarily having to put a lot of money in. Now, if you think, especially a stock might be $100 a share or maybe $500 a share, or there's quite a few of them now that are $1,000 a share. If you don't have that much money to put into it, you can have the fractional share but still gain the exposure that you want. So it's a great way to be able to diversify out with a much smaller dollar amount.
Good stuff. That is Matt Morzy, Director of Research and a CFP at Annex Wealth Management. Thank you.
Thank you.
Fred Coleman, CFP and a Wealth Manager at Annex Wealth Management. Thank you.
Thanks, Danny.